Hello, everybody, and welcome to the fourth quarter Blue Ridge webinar. We do these webinars for all of our clients, typically 4 times a year. So the next webinar is going to be coming up in January. So we'll start marketing for that webinar next at the beginning of next month. And that next webinar is going to be geared towards the data collection process. So your annual census you're going to provide to Blue Ridge and the questionnaire. But this presentation is geared towards newer ESOPs. So ESOPs which started in the last few years, or ESOPs with a new contact for Blue Ridge. So if you're just getting started on your ESOP as the administrator, working with Blue Ridge to administer your plan, this presentation is geared towards you. So we'll start off with a little bit of housekeeping before I introduce my two other co-hosts for today's webinar. I want to point out the Q&A feature at the bottom of the Zoom. So if you've got any questions throughout the presentation, please post those in the Q&A. There's also a chat feature, which will also send us a message, but we want to keep all the questions in the Q&A field to better organize them throughout the presentation. Before we get started, I want to point out nothing you're going to hear today should be considered tax advice or financial advice. If you've got any tax-related questions or finance-related questions, please reach out to an appropriate professional. Today's presentation is going to be recorded and sent out to everybody who's registered. So you'll get a copy of this recording and the slide deck. And then, without further ado, let me introduce everybody on the call. My name is Kip Custer. I am a Blue Ridge Plan Administrator. So I work with ESOP companies on their annual record keeping. My focus is on new ESOP clients and training the folks at the company, working on the ESOP on the company side. And I also work with advisors on the initial ESOP transaction, including setting the benefit level, putting the amortization schedule together, and focusing on plan design. Your other presenters today are part of our client relationship manager team, and I'll let them explain that role a little bit more, but we've got Linda Badillo and Emily Kopp.
Hey, thanks, Kip. This is Linda. As a client relationship manager, I have about 35 years of experience consulting with retirement plans. So anything from plan design, administration, compliance, communications. I have worked with all kinds of qualified retirement plans and non-qualified plans, executive comp plans, but with a concentration and a focus in ESOPs. And now I work exclusively with ESOPs, and I serve as an additional resource for the Blue Ridge administration team as well as for clients.
Thanks, Linda. This is Emily Kopp, also client relationship manager here at Blue Ridge. Really excited and happy to be here for today's webinar, and speaking to our newer and younger ESOP clients, as well as a couple of ESOPs or a few ESOP plans that have been around the block for a couple of rounds. So really excited to be here. So as client relationship manager, just to kind of reiterate Linda's points, making sure that you guys are all getting everything that you need out of your ESOP experience, whether it's with us or thinking about things in the future to help you make the most of your plan and your benefits that you're offering to your employees. So bring a little bit of background experience with consulting and compliance testing, but now kind of rounding that out with this more client relationship and client care aspect now in in this client relationship manager role. So thank you guys for joining us.
We'll start off going through today's agenda. So the primary goal of this webinar is to get you comfortable with the whole administrative process. So we're going to go through the basics of what ESOPs are, who the key players are in the game. So you've got Blue Ridge as one of your advisors. Who else are you working with, and how does everybody's role fit together? We'll go over the annual administration process, timeline, who's responsible for what, and how that relationship with Blue Ridge is going to work throughout the year. We'll go over the ESOP deposits that you're going to make. So these are your contributions and how this transitions to your employees' benefit level. So that's the share allocation to your employees. I'll talk about the fun ERISA compliance testing, everybody's favorite topic of the presentation. And then we'll go through what vesting is, distributions. These are common questions that you're going to get at the beginning of the ESOP. And then your communication with your employees and frequently asked questions at the end. I'll remind everybody about the question and answer, the Q&A feature at the bottom of the screen. So as we proceed and you have questions, put those in there. Try not to use the chat field.
Okay, thanks, Kip. I think I'm going to kick us off here. This is Linda. I think it's a great place to start to think about why a company would even implement an ESOP. You know, why not just go with some other type of retirement plan? Well, firstly, there are a number of companies out there where the owners are getting close to thinking about retiring and thinking about how that's going to work, what they'll do with the company when they do decide to retire. So forming the ESOP can be a really good transition tool for transitioning the ownership of the company to the employees, as opposed to, selling the company off to whatever organization and not having any control over what happens to the company or what happens to the employees that help build that company up. Now, when I say ownership, it's important to note that it's what we call a beneficial ownership. It's a little bit similar to me owning Apple shares, for example, in my investment portfolio. I'm technically an owner because I own shares, but I don't participate in management decisions about running the company. So the ESOP is similar. Your participants in the plan are beneficial owners owning shares in the company, but the company's management continues to make those management decisions and run the company. There is a big tax advantage to having the shares reside in the ESOP because it is a tax qualified retirement plan, meaning it does not pay income taxes. It is a good way sometimes for those shares to reside in a place where the earnings on those shares are not taxed. Now, I say that they are taxed eventually when participants take distributions from the plan. We'll talk a little bit more about that, or Emily was going to talk a little bit more about that. With the shared ownership in the company, there is, participants or employees always recognize the fact that what they do on a day-to-day basis contributes to the success of the company. But with the ESOP, they then can make that further connection that not only do they impact the success of the company and therefore helping the share price of the company, but that in turn benefits them as participants in the ESOP. So as the share price goes up, the value of their ESOP account goes up and benefits them directly. And for that reason, we do see that ESOP companies tend to outperform their non-ESOP peers. The ESOP is what we call a tax qualified retirement plan. So it is similar to a 401k plan in that regard. It has to be operated for the exclusive benefit of the plan participants and their beneficiaries. It does have to follow all of the rules that the 401k plan, for example, or any other qualified retirement plan has to follow with regard to vesting, distributions, with some exceptions, and eligibility. But it does differ than the 401k plan in that it is invested primarily in the stock of the company. So having a 401k plan, for example, invested primarily in employer stock can be very problematic, but it is actually a requirement that the ESOP, to be an ESOP, be invested primarily in the stock of the company. Unlike any other qualified retirement plan, including 401k plans, the ESOP is allowed to borrow money so that it can acquire the stock within the plan. And unlike the 401k plan, it is funded entirely with employer contributions. So no employee contributions going into the ESOP. So Kip mentioned talking about the key players. Who plays an important role? Well, you'll have a day-to-day contact at the company, and that's usually someone in HR or maybe someone in finance. Payroll plays an important role because the year-end census data is crucial to the administration of the plan and how the allocations are done within the plan. There will be a financial contact since there are contributions going into the plan that affect the corporate finances, and that can also be the same day-to-day contact. There is a trustee who is responsible for holding the assets of the ESOP, which will be stock primarily, sometimes some cash. And then, of course, the board of directors plays a very important role in making decisions about the operation of the plan in terms of the plan design. So they are responsible for, approving the plan document or approving amendments to the plan document, approving the contribution that's going to go into the ESOP and so forth. There will be a CPA and or tax accountant that plays a role within the ESOP. This person or firm will report the activity of the ESOP on the company's books and the corporate tax returns. This person may perform a plan audit, or there might be a separate firm that the company hires to conduct a plan audit. Now, with that said, small plans, generally speaking, under 100 participants are not required to have a plan audit, but those with 100 participants or more are required to have a plan audit. And one thing to note about booking the ESOP transactions on the corporate financials, ESOPs are not something that everybody's it just has lots and lots of experience with. There's just not as many ESOPs in effect as there are 401k plans, for example. So it's a really good idea to confirm that the CPA or the person that's going to be booking those transactions knows how to book the ESOP transactions. They can be a little bit unique, and your third-party administrator, Blue Ridge, for example, can help in that regard as well. The vast majority of ESOPs are not publicly traded. meaning that we can't just go out to the stock market and look at the share price on any given day. There has to be a valuation firm or a valuation advisor that calculates what the share price is for any given plan year. And that's quite a process. That does take some time, and it is an independent firm, so it's not somebody at the company just saying, hey, our stock is $10 a share. It is an independent firm that comes in and looks at the corporate books, all kinds of financial information, and then determines that share price. ESOPs will have legal counsel. This person may have even written the plan document, but the ESOP counsel can play a really important role in helping to determine some of the provisions or clarify some of the provisions of the plan document, or dealing with situations that just come up from time to time that are, kind of gray areas. And then, like Blue Ridge, you'll have a third-party administrator that's responsible for performing the plan's allocations, bringing participants' accounts up to date with the new share price, preparing participant statements, the 5500 that the plan has to file, and so forth.
Thanks,
And with
Linda.
that, there you go.
Thank you, Linda. This is Emily. I wanted to kind of, now that we know who the key players are for, the proper function and administration of your ESOP in a given year, wanted to provide a high-level overview of some major events that have to occur for your annual cycle. One thing to note is that every ESOP company is different. No ESOP is the same. Companies operate differently. So the timing of these different milestones in one ESOP company cycle might look different than another ESOP cycle. This is a very sequential process. So the timing of completing, for instance, step 2 depends on the completion of step 1, step 3 depends on step 2, etc. So just keeping that in mind kind of helps, identify the flow of this cycle from one year to the next. The first step is the company will close its books for the prior year and then provide their financials and information to their accounting firm CPA for review and or audit. And in turn, then those financial reports and audited financial statements will be provided to, you'll provide those over to the valuation firm and team. They're going to step in and, like Linda was saying, they'll work their magic. They'll review the financial reports. They'll review supplemental financial projections and forecasts. They'll also most likely conduct a due diligence meeting that's generally on site. And then once they finish analyzing the company's financials and conducting their due diligence, they'll provide their findings and draft valuation of the company's stock to the trustee. And the trustee is the one who will approve the valuation in order for the determination of the fair market value to be finalized. At that point, the third-party administrator or your TPA, Blue Ridge, will receive the fair market value from either you or from the trustee, depending on what the logistics are there. We'll coordinate that with our clients. And then we'll complete our annual compliance testing, prepare the final administration report, and produce the participant statements with the final share price. So for the first, one thing to note is that for the first administration year, it's important to budget some extra time into your timeline, just to allow the entire team, whether it's your internal ESOP team, your accountant, auditor, valuation firm, and TPA, to become familiar with the ESOP transaction itself, as well as the plan design and rules. And most importantly, for us to confirm and clarify your intent and expectations for how the plan is intended to operate. So early on in the process, we like to have a discussion with our clients on ways that you want to present your first round of participant statements, so that you can become familiar with the statement design options and the content, so that you and your team can review any questions about the statements ahead of time. So sometimes, a lot of times we, as client relationship managers, whenever we're talking to a new client or a new ESOP company, the biggest question that we get early on is there a checklist that we can follow, or is there a timeline? And the answer to that is yes. And we'll talk a little bit here about what the steps are of the ESOP administration, a little bit in more detail. So the first initial steps is really just data collection, and that's going to be happening on our end. We'll be collecting initial data from the company really early on in the plan year that we're doing the administration work. So while the company is closing their books for the year and getting the financials over to the accounting and audit teams, we'll be collecting from you your annual census file, any trust statements for the year, whether those are preliminary trust statements or bank statements for the ESOP, as well as the year-end letter questionnaire. And the questionnaire is really just something very similar to what you might already fill out for a 401k plan, to make sure that we've got all of our plan information and company information up to date, and we can make sure that the administration is done properly and we've got updated records each year. While we're scrubbing and analyzing the data that you've provided to us, you and the valuation firm will be working together to collect the data that the valuation team's going to need. While that's going on, while the valuation is in process, we'll then be moving forward with determining who's going to be eligible to receive a contribution allocation for the year. So there are two sets of basic, eligibility requirements for the plan. You've got your initial eligibility for an employee to become a participant in the plan, but then there's also eligibility requirements for a participant to receive a contribution each year. So once you're in the plan, that's one thing, but each year the participant also has to probably meet, generally speaking, and this depends on your plan document, of course, but generally speaking, there will also be requirements that the participant has to meet each year in order to receive a contribution allocation. Once we go through that determination of who's eligible to receive a contribution, if your plan is an audited plan, so like Linda was saying earlier, if the plan is a large plan filer where you've got over 100 participants, it's a good idea at this point to have your auditors take a look at the determination of eligible compensation. And the reason for this is to avoid any kind of surprises that might come up after the work that the TPA has done from coming up, from having to be revised. So this is early enough in the process where you can have the auditor come in, take a look at your payroll files, your W-2s, take a look at the plan's definition of compensation, the plan document's definition of compensation, and ensure that what is being used in terms of compensation in the census is correlating with the plan's definition of compensation. If this comes up, if the incorrect compensation is used or incorrect wages are used for allocation purposes, and this doesn't get caught until the audit is underway after the final report's been completed, it can create some issues and some headaches of having to adjust participant accounts, which we don't want that to happen for anyone. So it's just a good idea to kind of have your auditor, if you're a large plan, have your auditor take a look at the determination of eligible compensation early on in the process. Once we've done the posted allocations to participant accounts and received the valuation for the plan year end, we'll then finalize compliance testing, prepare the final administration report and the participant statements, and if applicable, if you're engaged for ESOP Connection, we'll open up ESOP Connection for your review before we open that up for your participants to log in and access their accounts and statements online. And then if it's applicable and you've engaged us to help you with your distributions for the plan, we'll move into processing distribution forms for your former participants, mailing those notices out. It's probably not going to be a major issue early on for new ESOPs, but planning for that, in the coming years, in the early on in the years, but maybe not the first year. Just keeping that on your radar that participant distributions will have to take place after the final administration report is completed. And then at that point, usually at the same time as distributions are being prepared, your audit team, if you're a large plan, will begin working on their audit. We'll help them answer any questions that they might have and provide them with sample requests and materials that they might need to conduct their audit. And then we'll prepare the Form 5500 for the ESOP, which is typically, it's for a calendar year plan. The filing deadline is July 31st, which is the last day of the 7th month following the end of the plan year. Many of our plans will file an extension that gives you an additional 2.5 months to file the 5500, which would, for a calendar year plan, move that filing deadline to October 15th. So employer contributions to the ESOP, like I said before, are allocated to participants' accounts each year, and that's in accordance with your plan's specific allocation provisions. Typically, this can be based on a participant's compensation, or maybe it's points, or maybe it's a combination of the two. If it is allocated on points, then this could be given based on wages or years of service with the company. Just keep in mind that if your plan does have a points allocation basis, there is some additional non-discrimination testing that's required for those types of allocations. In later years, as I mentioned before, You might have distributions to former participants, which would require an additional contribution, contribution to fund the distributions to your participants. And for many ESOPs, the ESOP purchased the stock that it holds with a loan, and that's a leveraged ESOP. So cash contributions would be required for leveraged ESOPs in order for the plan to make those loan repayments. So the company would be making a contribution of the annual loan repayment to the ESOP, and then the ESOP would then return those funds typically back to the company. It's important that the loan payments are made on time each year and on schedule. Otherwise, you might have some adjustments to the interest calculations, and this can impact the remaining loan payments on the ESOP note, and also the number of shares that are allocated each year to the participant accounts. So this could end up in different outcomes than what you originally intended for from an allocations perspective. So just keep that in mind, that you don't want to be straying far from the amortization schedule for your ESOP note, and to be making those loan payments for the correct amounts and on time. So Linda's going to give us a little bit of an overview of the loan payment and contribution process with this visual.
Yeah, thanks, Emily. I think this is one area that can be particularly confusing for those folks who have a new ESOP. It's not a terribly intuitive thing. So I'll try to break it down here. When you think about it, when the ESOP is set up, there's nothing in the plan. There's no cash with which to purchase the stock from the current owners, or what we call the selling shareholders. Now, so the ESOP will take out a loan from the company. And there are different ways you can structure this, but this is the most common. The ESOP will take out a loan from the company and use the proceeds of that loan to purchase the stock from the company. There are loan payments, just like any loan, just like your car loan, your house loan. It's amortized, and as Emily was talking about, you have an obligation, or the ESOP has the obligation as the borrower to make timely loan payments back to the company. But there's nothing but stock in the ESOP. So the company will make a cash contribution to the ESOP. That cash contribution is allocated to participants and used to release shares from a suspense account. So that stock that's leveraged is not yet in the participants' accounts. It's in the ESOP, it's in the trust, but it's not in participant accounts yet. So that cash contribution gets allocated to plan participants, and shares, a proportionate number of shares are released from that contribution, and that's how the participants get shares in their account. The ESOP then uses the cash contribution, turns right around, and makes the loan payment back to the company. So that's kind of a zero sum, in and out. Company deposits the cash to the ESOP trust, and the ESOP trust turns right around and makes its loan payment back to the company. Now, the other side of the equation is, I've been talking about the loan between the company and the ESOP. Well, the company didn't own the shares to begin with. There's some shareholders, owners of the company, and how do they get their shares purchased and paid for? So a very common strategy is for the company to take out a loan with a bank, typically, and use the proceeds of that loan to pay the selling shareholders for their stock. So that's how the owners get paid and how the stock ends up in the ESOP. It's important to note, and this can be a confusing item for new ESOPs, that the terms of the outside loan between the company and the bank have nothing to do with the terms of the loan between the ESOP and the company. So very, very typically, the loan between the bank and the company will be fairly short term because usually selling shareholders don't want to wait 30 years to get paid for their stock. So a fairly short term loan. But the loan between the ESOP and the company will typically be a much longer term because you don't want to allocate all of the shares within the ESOP to plan participants in a short window of time and then have no more shares to spread out across new participants in the plan. So that's it in a nutshell. Clear as mud. If there's questions, throw them in the Q&A there and we can address them. If not, I'll turn it over to Kip.
People have been putting questions in the Q&A. I love it. So I've been typing furiously, answering everyone's questions. So
awesome.
Keep sending those questions in, and I'll respond. Some of the responses have been pretty long, and there's no spell check feature on the Q&A section. So pay no attention to the spelling on my responses or the grammar. I'm used to Microsoft Word fixing all my mistakes. So just typing furiously to answer everybody's questions, but keep them coming. So now's the fun part. I alluded to this in the agenda that the compliance testing, that's what you pay Blue Ridge to handle. So this is required in the code section of ERISA for any qualified plan to meet certain requirements. We like to use the code section in a lot of these. Did we miss a slide? I thought the top heavy test was first. Oh no, you're right. We're good with the annual additions test. So a lot of times in the name of the test, we'll use the code section. So annual additions test is part of the Internal Revenue Code section 415. But to think about it more of the name of the test, so annual additions test, this covers annual additions to any qualified plan sponsored by the company. So typically you've got a 401k and then you establish the ESOP. So now we have to review if those contributions to your 401k plan, that's often employee deferrals and matching contributions, plus the ESOP contribution, that's new. And the other piece of annual additions would be any reallocated forfeitures inside the ESOP. So, as people gain vesting, or if they leave the company with an unvested balance, inside of the ESOP, those shares are forfeited based on timing in the plan document, but we reallocate those forfeitures to other participants in the plan. Those reallocated forfeitures are included in this combined test. So between those 401k contributions, the ESOP contributions, and reallocated forfeitures, no employee can get more than $72,000 allocated to them. Now, keep in mind there is a catch-up contribution. So if employees make catch-up contribution to the 401k plan, those catch-up contributions are not included in this test. So it's the limit does not consider catch-up contributions. Now, there's a note here on retroactive plans. So a lot of you guys, brand new ESOPs, part of Secure 2.0, the original Secure Act allowed qualified plans to be adopted after the close of the year. So as long as you adopt a plan before you file your tax return and you make a contribution for that year, you can make the plan effective. So let's say you did your contribution over the summer, so summer of 2025. you can make your plan effective January 1st, 2024. So there's lots of plans out there like that. If you do an accrued contribution, though, this is often for tax purposes to get a great tax deduction for that first year. That large cash contribution, that could cause you to exceed this limit. So this is a very common test we look at for new ESOPs because of that large initial contribution. So it's very important in the first couple years of your plan, if the ESOP was set up and there was large contributions made initially, this test could be a concern. And communicating that to affected participants is going to be very important. So having a strategy for this test and knowing it's going to pass or fail is really great planning. The other test is from Section 404A. This is the company deduction limit. So you can only, the ESOP contribution has a maximum, and that maximum is 25% of your covered payroll. So between all employer contributions, so if you've got a 401k and you're making a matching contribution, that matching contribution is an employer contribution. So your employer contributions would be that match and the ESOP contribution. The total of those contributions together can't exceed 25% of eligible payroll. Now, there's some nuances between being an S corporation and a C corporation. If you have any additional questions on this test, reach out to your Blue Ridge administrator and they can go into more details on how this affects your specific plan. The next test is Code Section 416. We never actually call the top-heavy test 416 very often. We typically just call it the top-heavy test. And you're used to doing this test with your 401k, unless your 401k is safe harbor. So if you've got a safe harbor 401k, you'll probably hear that word, but essentially, your matching contributions are typically 100% vested. There's a matching formula to make that 401k safe harbor, and that excludes you from the non-discrimination testing. So you don't have to do the average deferral percentage test, the average contribution percentage test, or the top-heavy test. So for many folks, this top-heavy test is actually a new test that they see when it comes to the ESOP because there's no safe harbor exclusion from this on the ESOP side for this top-heavy test. So we have to perform it. And it's very uncommon to fail this test as a new ESOP. It's typically the 401k that's causing this test to fail. This test essentially looks at key employees. So when we're doing compliance testing, we're going to determine highly compensated employees, which is used for non-discrimination testing. And then we determine key employees, which is used for top-heavy testing. So there's a difference between the uses of highly compensated employees and key employees. So a highly compensated employee would be somebody who earned in the prior year above a certain compensation threshold. So if they earned over $155,000 in 2024, they would be a highly compensated employee for 2025. If they were a 5% owner in the prior or current year, they're a highly compensated employee. But that's different. We use key employees for top-heavy testing. And you could see the listing here for a key employee. It's an officer earning greater than $230,000. Now that number is indexed for inflation. So this number is for 2025. That could go up. Someone who's more than a 5% owner is always a key employee. And a more than 1% owner whose compensation exceeds $150,000. Now, when looking at that ownership percentage, that does not consider ESOP ownership. So if the ESOP owns 100% of the company, which is commonly the case, you're not going to have any 5% or 1% owners. So the only way to be a key employee for 100% owned ESOP would be an officer beating that compensation limit. And you can only have 3 officers. I think it's the lesser of 10% of your employees are 3. So commonly, there's not very many key employees. There's broad-based participation in the ESOP. So this test, it's uncommon for it to fail. Now, the most important test that hopefully you've heard about, if you're an S corporation, so if you're a C corporation, this test does not apply to you, so you don't have to worry about the S Corp anti-abuse test. But for S corporations, this test is very important. So due to the tax benefits of an S corporation ESOP, the IRS has put in additional rules into the code to prevent companies abusing the tax law for ESOPs. And the goal for this S corporation ESOP is to have broad-based ownership. So there's a concentration test to see if the shares of the company, so we allocate shares to the employees throughout the year. So if that share allocation is too concentrated among individuals or family groups, this test could fail. And this is a test that you do not want to fail. Part of this, we look at the allocation of shares to see the concentration of ownership. We also look at family groups. So anybody who's related. And so this is pretty broad family relationships. So parent, child, siblings, grandparent, grandchild, but also the spouses of the folks on that list. So in-laws, you also want to include in there. So very broad-based family group rules. So if you know an employee is related to somebody else in any way, include that on our census data request because we'll need that for the 409P test. The other thing is synthetic equity. So if you've got equity-based compensation or something like a warrant or a stock option. So the most common forms of equity-based compensation would be a stock appreciation rights program or a deferred compensation program. There could be certain types of whole life insurance policies that are considered synthetic equity. But also if you have warrants, we would need to know about that when doing this test. So there's very significant penalties for failing. This is not a test you want to fail. So we want to monitor it very closely every year. So we want to do this test if you're an S corporation every single year. And this test technically has to pass every day of the year. The shares of the ESOP will only typically move once a year as of December 31st when we're doing the allocation. So we just do it on that one date, but just note that this test needs to pass every day of the year. Oh my gosh, there's one more test. Okay, the coverage testing. So section 410B ratio percentage test. This one looks at the highly compensated employees. So I went over the definition in the last tab, but Blue Ridge is part of the census data and eligible compensation review is going to determine who's a highly compensated employee and who's a key employee. And we just need to make sure that the highly compensated employees aren't benefiting in a discriminatory manner compared to the non-highly compensated employees. So this is what we call non-discrimination testing. It's uncommon for there to be an issue with this test, but this is one of the ones we do.
Thank you, Kip, for making that as palatable as possible. We appreciate your technical expertise there and high-level overview of the compliance testing. Thank you. One of the things that Kip mentioned earlier was talking a little bit about forfeitures, and that kind of ties into and directly ties into how much of a participant's account do they actually own? And that refers to the concept of vesting. So a participant's vested balance is going to be the portion of their account that they are entitled to own after they leave the company. Vested percentages are generally based on an employee's service. So as an example, if a participant has an account balance of $10,000 and they're 60% vested when they terminate employment, the participant would actually own $6,000 worth of his or her account, and the other 40% would be the amount that eventually becomes forfeited under the plan's rules. The most common vesting schedules that we see are a 6-year graded vesting schedule or a 3-year cliff. So a 6-year graded vesting schedule would be, after 2 years of service from if they have 0 or 1 year of service, they would be 0% vested. With 2 years of service, they'd be 20% vested. 3 years of service, they become 40% vested, and so on and so forth. It's like that step graded schedule where eventually by year 6, they would become fully or 100% vested. With a 3-year cliff vesting schedule, in years 0, 1, and 2, the participant would be 0% vested, but then at year 3, with 3 years of service, the participant would become fully or 100% vested in their account. Once a participant becomes fully vested in their account, they would no longer, they would not forfeit any of their balance under the plan's rules. Vesting is typically based on employee service with the company, as I mentioned before. Many times we see that years of service are defined by a number of hours that an employee works in a plan year. A lot of times we'll see immediate vesting applied or the vesting schedule to be waived if a participant terminates due to certain events such as death, disability, or attainment of normal retirement age. It's important that you confirm this with your plan documents, since each plan document is different and the plan rules are different for vesting purposes. So just check with your plan provisions, and if you don't want to do that, reach out to your Blue Ridge administrator, and they'll be more than happy to help you, find the answer to that question. What's your plan's definition of normal retirement age, and when participants will become fully vested upon a certain event. Something else to consider is that sometimes prior service before a plan's effective date is counted towards a participant's vesting, and sometimes vesting credit is not given until the plan's effective date. So it's important to kind of understand those rules and know the rules that you guys have in your plan documents, so that whenever you're speaking with your participants about the ownership percentages in their accounts and what service is counted for plan purposes is in line with what your plan rules are. So as I mentioned, once a participant terminates employment and we've determined what their vested percentage is in their account, the next kind of turn of events is the distribution. So payouts that a distribution from the plan, or payouts that the participants are going to be receiving after they leave the company, typically due to an event. So it's going to be death or disability or normal retirement age, or a regular, termination of employment. One thing that, whenever you're looking at distribution rules, your plan document is going to give you the greatest, most conservative payment timing that's possible, that the regs will permit or allow. Sometimes plans will have a separate distribution policy that will kind of give you a more focused and flexible, tailored approach to how you want to handle your distributions under your plan. But generally speaking, if you're just looking at your plan documents, distribution provisions, there's typically a waiting period that applies if a participant terminates due to any reason other than death, disability, or retirement. So many times if a balance is over a certain amount, there is a waiting period before a participant may request a distribution. There's also the option for a plan or for plans to have payments made over a period of 5 years. So 5 annual installments of account balances over a certain threshold. In addition, we do see some plans that have language in their documents that delay any distributions from the plan until the internal ESOP loan is repaid in full. Now, there's certain things that are exempt from that loan payment delay, but you'll just want to work with your consultant on those nuances. So some things that you should consider, with your distribution provisions and crafting a policy is, if you're going to be making lump sum distributions or paying installments, and what thresholds you're going to be setting for those different options. You'll also want to talk about, think about who's going to be, if your plan's going to make cash distributions or stock distributions from the plan. Again, speaking with your consultant about these different things and kind of making sure that they're on the same page is going to be important for the proper, distribution forms to be going out for one, and the ongoing administration of your plan. Also, you'll want to kind of hammer out who's going to be doing the distributions, who's going to be preparing the distribution paperwork for your participants. Is it going to be an internal thing? Are you going to work with Blue Ridge on this process? We do offer these services for our plans. So making sure that you know how that's going to be handled in advance, and getting those options lined up in advance is going to help you out and help out your consultant in the long run. I'm going to kind of speed it up here as we're running short on time, but diversification payments, those won't typically happen until the 10th year of your plan. Upon age 55 and 10 years of participation for a qualified participant. And then, just keep in mind that as your ESOP ages, your policy on how you're going to pay distributions might change as well. So kind of keeping in mind that you have options available to modify your distribution policy and modeling those after your cash flow obligations is really helpful to kind of forecast and understand what your funding is going to be required for future years.
Okay, thanks, Emily. I'm going to briefly cover some communications. I know we had some questions in the Q&A on this topic, but I'll be brief to get us out of here in the next 2 minutes. Communications, really important feature of your ESOP. I talked a little bit about that ESOP culture. That does take time. Forming an ESOP communications committee can be really helpful in that regard. Participants would otherwise just see the ESOP, when they get their statements once a year. So it's helpful to kind of drip communications throughout the year and keep that appreciation and excitement of the ESOP in front of them. You can do that through the website. Your communications committee can do meetings, in person and virtual. We do have a communications team. These are experts that have years of experience in all types of communication issues. They can help you with the stuff to go on the website, flyers, emails, presentations, both in person and virtual. So please reach out to your ESOP consultant for help in those areas as well. And I will quickly go through. We have listed some really common participant questions. These are the most common things that we see. A lot of it's the same thing that you would see in the 401k plan. How do I get in the plan? Everybody wants to know how they get their money out. But some of the things that might be unique to the ESOP is when do I get my statements? Emily covered, the timing, and you can see that that is not the same timing that they may be familiar with the 401k plan. Something that happens with brand new ESOPs is the stock price is suppressed very, very early on. So that may be a question to deal with. And again, reach out to your ESOP consultant for help with any of these questions, and we can pull in our communications team and get you the help that you need. Right at 3 o'clock Eastern. I know we're out of time, so Kip, I think maybe our suggestion would be if there are more questions, just reach out to your ESOP consultant, and if that person, doesn't have the answer, we'll find the answer for you. So we appreciate your partnership with us.
Thank you, everyone.
Yes, thank you everybody for joining. I answered as many questions as I can in the chat, but yeah, as Linda said, there's likely many more questions out there, so please do reach out to your Blue Ridge administrator. And thank you for joining us for our Q4 webinar. You guys enjoy the rest of the year and the holidays, and we'll see you guys in 2025.